let's start with the Ukraine tensions. How do you see that actually play out in the commodity space? What's your base case scenario?
Well, our base case is no disruption. It's very unlikely. If you think about, there's two sources of a disruption: sanctions or an accident. I'm not going to try to forecast an accident or within Ukraine or something like that. But if we think about the sanction imposed disruption, I like to call it mutually assured destruction. It's not in the interest of any party to stop flows of energy through Ukraine or even into Western Europe. Just given the fact that, Europe's so dependent upon it and Russia's very dependent upon those sales. And so when we think about, you could get an upside here, in terms of thinking about oil, it's probably worth maybe $2 a barrel. And on natural gas, $4 an MMBTU. But the other one to watch there is also grains. Ukraine is a big exporter of both wheat and corn.
And yet the anxiety over the tensions there already playing into prices, right? So how do you see this unfolding for those energy-starved countries, especially in Europe?
Well, if you did end up seeing, some type of a significant disruption, the market is extremely tight right now. Inventories are low, which means the market was very much exposed to even the smallest type of disruption. Because remember, there already is an energy crisis in Europe, which is part of the reason why you would argue Putin is positioning himself over Ukraine in the current environment. But even the oil market on a global basis, inventory is very low, spare capacity being exhausted, which also leaves the market very much exposed. But I want to emphasize oil's a little bit different. You can redirect it here. Probably the biggest impact on oil will be freight and tankers. If you did see a disruption, because you just moved that pipe oil that was going to Europe into the Baltics or the Black Sea and put it on ships. So, the market that could be really impacted here would be freight.
Jeff, if I can introduce a hypothetical here, what kind of impact would an Iran nuclear deal have on oil prices? How much of a resumption would oil flows from there affect the market?
Well, our base case is that in 2023, you would end up seeing 1 million barrels per day spread over, from, the second quarter to the end of the year. That would obviously be significant, but that's over a year from now. It's very unlikely that you're going to see a deal done between now and the midterm elections, which is part of the reason it's been pushed back. And the market's discounting one. In terms of looking at how the talks are progressing, they're far from the point of having a deal. But yeah, you're right. That would be one way to overcome that. It would take a long time. You're talking, 3 months at least, just to get the inspectors in there and resolve some of the issues around, the inspectors looking at the uranium enrichment. So I think, thinking about it as being a quick solution to the problem, it's definitely not.
You mentioned a moment ago the importance of Ukraine in terms of being a wheat producer. Food inflation's already hit a decade high. How sticky do you expect that to be?
Well, our base case is a commodity super cycle that includes, oil, metals, grains, the entire commodity complex. And metals and grains have been the ones that would probably be the more sticky longer term here when we think about the potential for, a multi-year, potential decade type commodity super cycle. So, our outlook in, grains is some modest upside here. Not a lot, at least this year. But if you get, the weather's already bad in Latin America, which just exacerbates the problems that were already created last year. So while I do want to emphasize, inventories of wheat and corn are not as critical as they are in gas and in oil. However, the harvest in Latin America looks to be, disappointing, which means as we move towards the end of the year, that could be, the buffer could be erased.
And Jeff, given the rising prices there and with oil and other commodities, we continue to see those inflationary pressures, and Goldman Sachs is even warning that we might see a growth shock if we do see a sharp monetary tightening coming from central banks. So how do you really combine this with your outlook for the commodity space, given the growth picture out there?
Commodities are a late cycle hedge. In fact, they are the best hedge against, rate hikes, inflationary pressures, because ultimately when we think about when you initially hike the rates, it impacts the valuations of equities and financial markets, but its impact on the real economy is a ways out. And here's an important point: what creates the negative correlation between commodities and financial markets is that commodities depend on the level of demand versus the level of supply. If that growth rate slows and demand still above supply, still see upward pressure on prices. Financial markets depend upon that growth rate. Commodity markets depend on demand being above supply. Even in a declining market at the end of the business cycle, demand's above supply, which still gives you that diversification of commodities going higher as the equities are coming off. So the key point here, commodities are late cycle instruments, and in fact, we advocating putting them in a portfolio right now.
And how do you factor in the fact that, remember last year we had this different picture where Western central banks were actually in easing posture, but now we have them trying to tighten. At the same time, the PBOC going the other way around. So with this policy divergence, how does that really factor into the commodity space?
Well, that's if you look at 2020, China had the foot on the accelerator, and Europe and the US were struggling to come out of the pandemic. So it was the opposite then. Then you had the flip-flop in 2021, and 2022 looks to go the other direction. Commodities are global markets. So they're very much dependent upon what happens, throughout the world, and the demand levels in places like China, in the U.S., in Europe, all matter simultaneously. That's why what we're facing in oil and the rest of them is a scarcity situation. Some consumers going to get rationed out of these markets somewhere in the world. The biggest candidate are emerging markets like India, Brazil, Indonesia, China, U.S. and Europe. You're unlikely to see, a substantial slowdown in growth. I think the biggest risk in China right now on oil is Omicron.
You say commodities make sense in a late cycle, but if we look at a couple of commodities, and I'm thinking lithium, nickel, other products that are essential to EVs, what tailwinds do they bring to the late cycle as well? Is that what you say, but even more so?
If I were to pick, the green metals, and there's 6 green metals: copper, aluminum, nickel, silver, lithium, and cobalt. You picked, nickel and lithium are not our favorites. The ones we would focus on in terms of the green metals would be copper and aluminum. And aluminum, we like to call it the climate change paradox. You need it to solve global warming, but it creates the greatest emissions of all the commodities, which makes it extremely tight right now. Our target on aluminum is 3,500 a ton, and on copper, we're 12,000 a ton. I like to point out, copper is the new oil. Copper is the most strategically important commodity, and it's really king to this story.
Aluminium, probably, forgive my European pronunciation of it, a good way to circle back to Russia. As tensions increase, what does that mean for the price of aluminium?
I think, when you look at Ali, it fell victim to the sanctions over election tampering back in 2018. And by the way, that's an important point here. The Russians have seen those swift sanctions before in 2018, and it had a profound impact on the global aluminum market because it shut everything down. But because they have seen those types of sanctions before, Russia has made the preparations to be able to deal with them in the future. I like to point out they sold $83 billion of treasuries since then, stockpiled their central bank with gold, even greenbacks, to be able to deal with any type of stoppage of the SWIFT. So I think in terms of looking at potential disruptions in aluminium, to use the European term, pretty unlikely right now, just because they've seen it happen in 2018.